Welcome to Early Edge Club. This is an internal stock pitch shared by a member of our core community. Consider this as a window into how an experienced investor analyzes a business. The presenter and other core community members may hold position in the stock discussed, and their views or position may change over time. Early Edge Club is built around a small microcap focused core community of about 10 investors. Each of them have over 5 plus years of investing experience. If you would like to learn how we think about businesses and follow what we are building at Early Edge Club, you are welcome to join our WhatsApp community. And if you are an experienced investor, you can also express interest in being part of our core community. You'll find the link to both below. This content is shared purely for educational purpose to understand the business and the underlying thesis and not a buy or a sell recommendation. So let's begin.
Cantabil, I approached more of a top-down view to understand because Cantabil was a stock that I don't hold position, and the reason the way I was introduced to Cantabil was in one of the TIA event. Ambit Capital, the microcap fund manager, came. He didn't explicitly say about Cantabil. He was talking about different management, and he was talking about a retail company where the management was very proactive in listening to the feedback, etc., and how they implemented it. So I got very curious and I went and asked the manager which company it was, and he said it was Cantabil, and that's where it piqued my curiosity. As Cantabil is into men's retail, I wanted to first understand what is the market opportunity when it comes to men's retail, because when we look at retail like trend, it's always combined with men, women put together. But when you just take men as a bracket, like what is the different bifurcation? Recently in 2023, there was a company which came with an IPO, Credo brand, that was they are also into men's retail. So Technopark did their brief industry outlook. So I'm just quickly going to run through it, not take much time of it. So basically, if you take retail as a percentage of our market opportunity, this is GDP, and 50% of it is private consumption, and retail forms 48% of it, within which apparel and accessories form 7.2% as of 2023. That is when the research was done, and they are projecting to grow it at 20% CAGR. I find it a bit aggressive, but anyway, like around they might have done their own this. And within apparel and apparel accessories, the bifurcation is between men's, women, and kids wear. And menswear form around 41% of the market, and within menswear, Western wear dominate with around 94% market share, and ethnic wear only contribute 7%, which is ironic. With women's wear, it is around 75%, which is ethnic wear. So we are more lean towards Western wear, less towards ethnic wear. And this table gives you a brief year of different. So everything, if you see, they're projecting to grow northwards of 15% from shirts, trouser, everything. More than this, what attracted my attention was, is this tab disturbing? Let me, how do I move this down? Anyway, yeah. So when it comes to market segmentation between organized and unorganized, even now for around 44% of men's apparel is unorganized. So that's a huge opportunity which I actually see, and they projected to be around 60%. And within organized apparel market, the split is obvious. I'm not going to take much into it. It's basically exclusive brand outlet, multi-brand outlet, large format store, and e-commerce. What you could see here is exclusive brand outlet is growing at the highest pace among all the other formats. Multi-brand outlet is not growing at that level. This is very important to understand when it comes to Cantabil retail, because they are completely focused on EBOs. So what is driving few trends that are driving men's Western wear is, like, one, the young demographics and the lifestyle shifts that we are having within the population. And also in offices, we see casual Fridays. There's a lot of trends towards casualization where we prefer denim, athleisure, casual loungewear. And also there's a lot of trend happening with Western clothes fusioned with Indian ethnic wear, and merging ethnic wear with Western styling. One thing is lifestyle based purchases. Currently, we have different clothes for different purposes. Like for party, we have different clothes for gym, travel. So this is all driving demand. This is what I really see huge opportunity is, one, how the purchases are being influenced. A lot of expansion is happening in tier 2 and tier 3 cities, and a lot of local influences are shaping how men in these cities are shopping. And if you look at the opportunities within Tier 2 and Tier 3, which is where Cantabil is largely focusing, so this is the current split of all the urban population. And if you just take Tier 2 and Tier 3, that is around 58% of the market opportunity. They do have the outlets in Tier 2, but they're more focused on Tier 2 and Tier 3. Yeah. Go a bit deeper into what I did is I wanted to look at all the different players that are available in the space to understand like where Cantabil actually fits, whether Cantabil is creating any kind of a moat in the market. And so I just let me take you through first what different players I have shortlisted for this. So basically, Cantabil, they only have a single brand and they basically have a small manufacturing, one by third of their thing is manufactured in house, and they are mostly catering to economy to mid premium segments, mostly to men, like 10% is women's and kid. And as of Q1 FY26, they have 605 EBOs, and they are more focused on Tier 2, Tier 3, and they are completely focused more into Coco style formats, which forms nearly 78%. And some few things they have done around 720 last year. They aim to achieve 1,000 crores by FY27, which is around, and they plan to increase the number of EBOs to 725 and newer categories as well, accessories within their stores like footwear, etc. So when I was looking at other brands, they actually have multiple brands within them. So if you take Monte Carlo, they have cotton wear, which is major men's within that, but then they also expanded to home textile. So focus is one thing that I was not able to find with a few other players, which I shortlisted, and they are guiding for 10 to 11% revenue growth and margin of 19%. Corrado brand, I did find focus. They were only focusing on one brand, which is Mufti, but then they are positioning themselves to be in the mid premium to premium segment. And they are available across formats from EBOs to MBOs and large format store and online. And when it comes to EBOs as well, they are evenly split between Coco, Fofo, and Cofo. But then there's a structural change. They have not been able to grow much, maybe because mid premium to premium segment is not appealing, or people in Tier 2, Tier 3 are finding it expensive. So they are going through a period of this, where 26 and 27 would be brand repositioning, etc. So there's some structural change happening there. Keval Kiran Clothing is again more into men's denim wear. They have done really well over the last few years. And recently, they've also acquired 50% on cross casuals, which to enter into women casual denim wear segment. And they also have their own manufacturing segment. And they are one of the few players which are guiding in line with Cantabil in terms of growth of 18 to 20%. And they plan to achieve 1,500 crores in revenue with EBO. The EBO, again, they are more lean to FOFO rather than COCO. Aravind Fashion is more lean to premium to bridge to luxury segment. They have a lot of these international brands which they have tied up to, and they are basically directly retailing through their retail outlet and wholesale, and they have even split between retail and wholesale. When it comes to EBOs, it's all for full-led expansion. Very few brands they have their own Coco stores. And but then again, when it comes to growth, they are targeting 12 to 15% growth rate is what in the medium term, and plan to open around 150 EBO stores by FY26. CRM Silks is the reason why I included is because it's more of a fabric manufacturer traditionally, but then they've started piloting to the direct to consumer through these two brands, and they are using a Coco first approach. So it is very interesting to see how they evolve. Again, 10 to 12% growth, and the new business is going to contribute to around 75 to 80 is what they are guiding for. What I did is like I tried to consolidate a few of the interesting metrics of these companies and to find how they have progressed and what is standing where. As we all know, after COVID, like the year FY23, FY24 was a period of normalization, and there was a consolidation. So I just wanted to see how different brands year on year sales have progressed during the period, during the tough phase, which gives insight into the moat that would be inherent in the business. So what I've highlighted is any growth below 10% is what I've highlighted. And as you can see, there was only one. But then if you take across the board, you can see the growth stagnates whenever there's a slowdown in the economy. And that is something I really liked about Cantabil, where there's a consistency in growth even during tough periods of time. So that is one interesting thing I found out. When it comes to gross margin, yes, they have complete control in terms of they don't have to share anything with their franchisee partners. So they have one of the highest gross margin in terms of in the industry, which you can clearly see. Transformation for Cantabil, I'll take you through the journey, happened post around 2018, 19, and then it is complete. The company has been optimizing. So you can see like the last 5 years, it has been steady. Even in terms of PAT margin, 2021, you can see it's COVID years, but then it's been stable around 10%. Keval Kiran, you could say it's best in the industry, but then it's more FOFO led. Even in spite of other brands being FOFO led, they're not able to manage with Cantabil. A lot of depreciation and lease liability is being captured in PAT. So you can see, like, in spite of that, Cantabil is able to maintain 10% PAT margin, which is much better than other business model, which is FOFO, where you don't actually have to put capex. So that's something interesting. ROE, ROCE has been really good for the company, like consistently around 20%, even in ROCE, which is actually a better metric because it captures both equity and debt together. Keval is a bit better, but again, it is asset light, but again, it is a bit asset heavy because of the kind of COCO model, still around 18-20%. That is across the past 5 years. In terms of borrowing, Credo and Cantabil follow more of EBO. So the borrowings over there I find less, both long term and short term. If you look at screener, you see borrowing, it is mostly to do with lease liability. So that is not the borrowing, it's basically accounting standards which is being captured. But otherwise, the borrowing for Arvind Fashion and other brands are slowly, they're more dependent on short term borrowing. So even on the balance sheet strength, Cantabil is really good. One of the problems which a lot of people say is the inventory days for Cantabil, which is extremely high. I have calculated this from Screener. I've taken cost of goods sold, but then if you take the presentation, they would say it is around 140 days or something, but they have taken revenue in the calculation. I have taken cost of goods sold. So it's just how we have accounted. But anyway, I would say don't look at inventory in isolation. If you take DSO, because they're collecting the payment upfront, you see the DSO is extremely low. It's just in single digits. But then for other brands, the DSO is much higher, which is if you combine everything and look into the cash conversion cycle, it comes to around 250 days for Cantabil, which is in line. Arun Fashion has a mode, so they're able to do a bit more better in terms of collecting the payment as well. It's an outlier, but otherwise, it is the only pain point I would say. But otherwise, considering how they are keeping the inventory, even though they keep the inventory in their books, that is one of the reasons. I hope I would have built a case as to with different matrices why Cantabil stands out within the men's retail. Now, before I go a bit more deeper into it, let me just take into their journey, what happened and how the management has evolved. This will also guide us as to how the management's thought process is. Basically, Cantabil was founded by Mr. Vijay Bansal. He started as a trader of garments, etc. But then he found an opportunity in 2000 and he opened the first Cantabil store in Delhi, where he pivoted from trading. 25 he reached around 25 stores. This is actually very well captured by Congruence Advisor. So they have marked in different phases from 2005 to 2010. He aggressively opened different stores. Like by 2012, he had around 411 stores opened. They came up with IPO in 2010. At that time, Coutons was another discount brand that was aggressively opening, and he wanted to compete with them. So he opened another brand, Lafnos. But then things started to change between 2011 to 14. There was slowdown, and it was unsustainable. The debt started piling up, and he had to close down a lot of stores. So the losses were also piling up, and then the debt level rose. So he took necessary steps. He started closing stores. So from 349 stores around FY11 to they came down to 145 stores. The income also dropped. So this is the fear. This is a case where there was a backstep and cleanup phase, I would say. And the next phase is where there was recovery and stabilization. So he learned from the mistake, started prioritizing on quality, on work quality, and on store level profitability and operational efficiency. And that is what has shaped Cantabil right now, is what I would say. And slowly from 2015, they regrouped, they started adding prudently stores. So there was no much growth, just 8%. The income grew with the store addition, but store addition was very less, and the cleanup phase happened. And bit from 2019 to 2024, and now they started implementing a lot of new things like ERP system, entering into e-commerce, launched store in Nepal, and also diversifying into footwear, athleisure, and they were much more conservative, and they have realized that not to take debt and use internal accrual to fuel their growth, and that's what they have been doing from then. This is the management. Vijay Bansal is the founder. His son, he joined in 2008. So even the next gen is having the same mindset. They have gone through the phase along with the fathers. So they're a kind of a thought process has set and learning has been set and embedded within the management, and which is a good thing. When it comes to their operation currently, these are the different locations. They follow more of a cluster based approach, and that's why you see they are not present much in south. So any one state they try to open few stores, so they're able to manage their supply chain efficiently, and that's how they are progressing. So that's still a lot of opportunity when they have in terms of expansion in India. When you look at few operating indicators like cocoa and FOCO split, they're more inclined to for cocoa. It was around 75 25. That's how they have experimenting with largest format store. It used to be 1,200 square feet. For the last 2 3 years, they are experimenting with 1,700 square feet store, and that's why this dip. But otherwise, the other few entries pretty stable. When you look at the operating indicators, they're more focused on men's store, men's, ladies, and family. These are the three categories they're more focused on, and that's where you see the maximum revenue as well. Men's dominates naturally, and the split wise, as you can see, is more towards 78% is now cocoa. East, central, and south, there's still a lot of opportunity for them to take advantage of. So coming to unit economics, this is very important. So these are the different buckets of sizes they generally open. This is what they're experimenting more on. So generally, I have data. They have given data for 1,200. The other store formats were extrapolated from that. So this is what the management guides for. Like capex is around 50 lakhs, and inventory for 1,200 store. Inventory is around 37 lakhs for a 1,200 square feet store, which brings the total investment to around 87 lakh. This is on the higher side. So the revenue is calculated based on sales per square feet of FY25 numbers into 1,200, which is 1.12 crores, and net profit from the net profit margin of 10%, which brings around 11 lakhs per year. Sorry, 11 lakhs per month. This is actually, yeah. This is actually again cross verified. I did call few Cantabil stores. 10 lakhs is what they give a number. So this looks like what? And this, when you extrapolate with the annual figure, also tallies. So with a 5 to 7% margin, break even time is around 6 months, and payback period is 2 to 2.5 years at the max. Some interesting things, strategies that I like is instead of flat discounting, they are one of the few companies that buy together, get discount offering. So this moves the volume, and they're able to bundle different non-moving items, etc., and also increase the volume. They don't believe much in opening in malls. They believe in opening stores in high street. They have a 50% repeat customer. This also keeps their rental cost in control, in check. In terms of production, they have a very good split between 1/3 in-house and 1/3 with dedicated fabricators and 1/3 for external sourcing. And this gives them some flexibility and also speed of replacement. Online, they just started in 2022. Now, online is just 5% of the sale, and that is something to watch out for. They have an omni-channel, so any stale stock, they have 200 stores, mini warehouse in different parts of the state where they are present in, and which they used to the stales, the old inventory, and they use online to clear age stocks, so EBOs, old stocks which are of full price, and they expect online to contribute around 8 to 9% by FY27. Few guidance by the management is, as I mentioned before, by 2027, 1,000 crores is what they're targeting for. This gives this brings CAGR of 17 to 18%, which is very conservative, I would say. Sales SSG of around 5 to 6%. Then there's also volume growth, and put together, you have for FY26, 20% growth is what they're targeting for. And if this number is achieved in FY26, then I think they could surpass the 1,000 crores number. Store count is 725. By the September end release, they have a store of 632 in 2 years, like adding another 98 stores looks very possible. 1,200 square feet of retail space is what they plan to add by FY26, and they want to keep the current mix of men's, ladies, and store. But also, one thing they are pivoting is on experimenting with larger format site, which I would like keenly watch on. That focus again between the tier cities is going to be 20% tier 1 towns, 40% between tier 2 and tier 3, which they would want to maintain. And also they're guiding to maintain the EBITDA margin of 28 to 30%, gross margin of 55 to 56%. Marketing expenses only 1.5% of the sales. I've seen other brands which we have compared, the marketing expenses is plus 5%. And their high street approach is actually working, which is actually reducing their marketing need for marketing as well. And working capital days is around 110 to 115. The difference I mentioned is because how I calculated is a bit different. Funding, all this they are committing to fund through internal accruals, so there's not going to be much dilution happening. And there's also additional on top of that, they're committing to a 20 to 25 crore capex on new warehouse and a corporate facility going forward. So key risk that I see is, so retail is definitely intensely competitive. Taste preference, there's going to be seasonality, macroeconomic factors to dictate. SSG pressure is going to be there. But if you have seen the ROE, ROC chart across retail, Cantabil, yes, during period of 16 to 19, they were going. But even if you looked at studied other companies, they were able to generate around 15 plus ROC. And during this period, you had demonetization, economic slowdown with this. If you got your unit economics right and your mix up is definitely an interesting space to be. Cantabil largely focus on cocoa. A lot of growth would be dependent on store addition. If they stop adding new store, then the SG is going to be 6 to 7%. But then again, your cash flow is still going to be there. But then, yeah. So that is something you need to be mindful of. Demand volatility and regional concentration and rollout quality is something to be mindful of. And inventory and working capital stretch is again one of the key risks that the company faces. When it comes to valuation, I'll take you through Screener. I do this for valuation. 1 second. Yeah. Is my screen visible? Yes, the screen. So I run this tool, which is Smart Analyzer. So it's an interesting tool you can try on different companies. So basically, the current price is 245, pre is 2026. So one thing is what is interesting is it gives a best and the worst case based on historical growth rate. So even at the worst case, the margin size would be sustained. Unfortunately, you can't change revenue figure. And if you're able to, if the company maintains the PE, then the price targets on a 1 year forward basis comes to 283. It is currently at 245. According to me, between this period is a good period to slowly start accumulating the stock for a longer structural growth story. One other thing which I like to do is personally to understand how much of the growth is embedded in the current price. So if you see the cash flow from operating activities, it is around 150 crores. But then it's a very high cash generating machine. Even after the capex, if you see the capex they have done for last year is 50 or 48 crores, and it's going to be around the same level. You get around what I would say is around 100 crores of free cash flow. But if you again exclude, because a lot of lease liabilities get into play here, so it comes to around 78 crores is what I would say, because it captures most of the things. So even if you key in your earnings 78 crores, and if your required rate of return is 20%, terminal growth rate 3, and if you have a holding period of 5 years, and if you give a multiple of 25, which is the average multiple, your implied earnings growth rate has to be 16 point, which is what the management is guiding for. They are saying that they would be able to grow at 20% CAGR, and even if they achieve 20, even if they achieve the 1,000 crores target in by FY27, a 20% CAGR from this point is very much plausible without taking on much risk. And if you see the chart as well, once the transformation phase restructuring has happened, there has been a run up. And now, over the last 3 years, it has been consolidating. I think the consolidation is happening. It is very good the time you have got a time-based consolidation as well. And it's a good time to slowly start accumulating at this point in time.